Hi, welcome back. I'd like to finish off in this video our discussion of Chapter 5, Measuring Risk Part 1B. And where we left off, as you may recall, we were ready to do an example using our opportunity cost of capital to help us with the IRR method of project evaluation. So specifically what I'd like to do is I'd like to jump back to the Apex project, development of the Apex apartments, and see how we can use opportunity cost of capital with internal rate of return to do a better job of evaluating this project than we have so far. Okay, so first thing we've got to do to get our opportunity cost of capital is to define our investment mission. So in this example, we're going to pretend that we're CAG, and CAG is a developer of off-campus multifamily rental properties for students. So CAG would say something like, we invest in the development of multifamily properties rented primarily to students. We do this as equity investors, so we're the sponsor. We put our own money into this and we take out loans as appropriate. Um, and so now that we know our mission, we have to search around the world for an appropriate opportunity cost investment. And remember, that's going to be a diversified set of investment projects in multifamily properties, hopefully for a demographic like students, like graduate students. So we're going to search for, this is a little tricky and this is the way it works in the real world. The closest thing I could come up to for CAG with data that I could find was to go into the home builder industry. Home builders are companies that make single family homes as well as multifamily residents. Try to find one that's multifamily and see if I could get some data from them. So I looked around, and the best thing that I could find was Clayton Homes, which used to be a publicly traded company. It's since been acquired by Berkshire Hathaway, but data on Clayton Homes is still available publicly. They develop largely, their mission is largely to develop middle class multifamily properties. They develop about 20 buildings per year with about 50 units per building. So in a year, they're diversified. I'd be more comfortable if they did 30 buildings a year or more. But life ain't fair, and nothing is ever perfect in the real world. So we're going to go ahead and use Clayton anyway. Um, so now that I've got the opportunity cost investment, I use that to determine my opportunity cost of capital. So what I did for Clayton was I developed for the past 10 years the after-tax return, including dividends and stock price appreciation, that an equity investor would have seen with Clayton. So I've got year 10, they returned 10.10%, pretty awesome, right? 9.9%. Year 8 minus 3.1%, and et cetera, et cetera, et cetera. Average is about 8% for the past 10 years. So using these 10 years worth of data, I'm going to say the opportunity cost of capital is going to be the average return of CHH. Remember, that's about 20 multifamily properties a year. So it is a diversified portfolio of properties, and that return, that opportunity cost of capital return, is 8%. Okay, couple things to note here. If Clayton Homes was still publicly traded, we could, if someone gave us a blob of money and we didn't know what to do with it, we could invest that money in shares of Clayton Homes and hopefully on average receive a return of 8%. Um, and so what we're gonna want to do is, with that in our pocket, we're gonna want to think about individual projects like Apex, compute their internal rate of return, and then if the internal rate of return of a potential development project for us is more than 8%, we're gonna say, oh, that's great, let's go for it. And if not, maybe we'll park our money in Clayton Homes for a while and hopefully enjoy 8% on average. The other thing I want to say while we're on this page is you'll notice here the average return is 8%, but on a year by year basis, Clayton is all over the map. So there's no guarantee here we're going to receive our 8% cost of capital. 8% cost of capital is always an expected value, okay? And it may be pretty good if our mission is to invest in something like treasury securities that never do flame out. But when we're doing something like making equity investments in developments, this average is going to be a real random variable with a real standard deviation, include some historical years of negative returns, etc. Okay, so with those two things in our back pocket, let's move on. So like I said, we're going to use this opportunity cost of capital in our IRR method for Apex, which is specifically going to mean that we're estimating that Apex Apartments development fits our above mission. I think it does. Clayton doesn't specialize, well, certainly fits our mission. You could argue about opportunity cost of capital. Clayton doesn't specialize in multifamily residence for graduate students, but good enough. So now for the Apex project, what do we have to do? We have to determine all of the development's cash flows and the price that we will pay for them, as we have done previously with Apex. And again, remember, all the development's cash flows for the sponsor, the equity investor, uh, CAG, and CAG is of course also called the sponsor. Um, and now we'll need to solve for the Apex development internal rate of return, which we've already done. Um, and we're going to compare this to the opportunity cost of capital. So I apologize for the typo there. So we'll say compare this to the opportunity cost of capital. And then again, if the internal rate of return, the average compound annual interest rate we're going to get from Apex is better than our expected value average return for just throwing our money into Clayton Homes, we're going to go ahead. And if not, we would presumably throw our money into Clayton Homes because we don't want to get zero. We're in the business of developing things. So if we can't find our own project to invest in, good idea to maybe invest in a diversified set of projects of someone else's. Okay, um, so we have done that in the Excel. Um, and I'll go ahead and show you, I'll bring up an Excel in the next part of this video to show you how this is all going to work out numerically in detail, comparing our opportunity cost of capital of 8% to our internal rate of return we compute. computed for Apex. That'll be next part of this video. That'll be a standalone video. Next step. Okay. But before we do that, I do want to talk briefly about other risk models. Okay. Um, in finance, in real estate finance and general finance, there are several other risk models aimed at determining RM or ROCC. So let me write that in. Finding RM or ROCC. And again, as usual, RM or R market is the same in general as opportunity cost of capital, the way that we've defined it. Of the several other methods we can talk about, I'm just going to talk about one, which comes up most often. It's called the Capital Asset Pricing Model, or CAPM. Okay, it is covered in detail in my finance text if you're interested. We don't have time to go that far. It's not appropriate for us to go that far in this class. So here's how the CAPM works. It says, first of all, we're going to discount cash flows to an entity's owners. So this is only going to work for sponsors, equity investors. It's not really aimed at lenders and things like that. And it's usually used for valuing a whole company, okay, not so much a project. Another problem with CAPM. So what it says is our equity, the return for equity holders is equal to our risk-free rate, same risk-free rate we've been talking about before, which is from treasuries and includes interest rate risk and inflation risk and a very small probability of treasury default risk, plus a constant called beta times RM, there's our market, minus RRF. Okay. And in this case, RM has a slightly different meaning than we've been using it for. So here I'm going to say our equity is ROCC. What the CAPM model means by RM is the overall risk of the equity market, okay? Um, and that's going to typically mean all the stocks in the publicly traded stock market. RM minus RF is that delta for market risk, in this case, market risk of the entire stock market. Beta aims to measure how closely our particular project, the company that we're trying to value, is related to the overall market. And CAPM uses the corresponding cash flows we want to use in CAPM, our project risk adjusted cash flows. Okay. And couple things to note here. These notes are fine. I just covered them when we were on the last slide. CAPM is it's notoriously not very accurate. It's used anyway to value stocks. And what are we valuing when we're valuing stocks? We're valuing entities, right? Companies. If you own 100% of the stock, you own 100% of the firm, right? So we're valuing entities because it's formulaic. And the data needed to use it is available. for publicly traded companies. And the last thing I'm going to say here, you'll be very happy about, is you will not be tested on CAPM in this class. Okay, I just want you to know about it because it is going to come up if you decide to work for a real estate private equity firm, if you want to take a course in corporate finance or advanced corporate finance, that type of thing. Okay, back again. Now I'm ready to use the opportunity cost of capital, ROCC, that we've computed for CAG, and see how they should apply that to an internal rate of return analysis of the APEX project. So I've gone back to our APEX financial plan spreadsheet here, where again we listed all the development costs month by month, and we went to a lender who said they'd lend against some of these costs, but not all of them. Um, and from that and the terms of the loan, we could get everybody's comprehensive comprehensive cash flows for the lender and for equity. And we're concerned right now with equity because we want to know if CAG should go ahead with this project. And then down here, we computed the IRR for the lender, and using comprehensive cash flows, we did the same thing for CAG, and we found that their IRR was 1.13% per month. But we need to use the EAIR formula to morph that into an annual internal rate of return, which is 14.48%, which is pretty good here. So now I can just say here, compare to ROCC of 8%, and what does that mean? Uh, it means go for it. That's the awesome thing about the opportunity cost of capital, is that once you know your opportunity cost of capital for your financial mission in life, um, any new project in that mission, in that milieu, that financial milieu you're thinking about taking on, just get the IRR, compare it to um, the opportunity cost of capital that you have, and if the IRR is greater and you want to go for it, and if the IRR is not, you don't want to go for it. Okay, now that I've misled you with that, just kidding. Now that we've got that in our pocket, I need to add a serious qualifier and let you know of what's coming up next. Okay. Um, Using internal rate of return for sponsors, for equity investors, for developers, is not optimal. And the reason why is, remember the numerical problems we might have computing internal rate of return, finding the roots of a polynomial of order 8, 20, 10, or a real equation if the timing of our cash flows doesn't always happen at the end of the year or end of a month. With developers, this becomes a very real problem because sometimes you'll have to put in money for phase one and then you get some positive cash flows. Then you have to put in more money for phase two, then you get more positive cash flows, etc. For a general cash flow diagram like that, where you have positive and negative cash flows occurring at any old time, it's very, very difficult and sometimes impossible to compute the IRR. So I know I've gone ahead and shown you how to use it here for CAG. In general, IRR is used all the time for lenders, and it's very good for lenders because typically they throw a blob of money out there and then they get paid back with interest over time. So that one negative cash flow at the beginning of the project, um, and then a lot of positive cash flows later. That would be the case of a mortgage or for a development loan. They continually throw out negative cash flows until the very end when they get one big positive cash flow coming back. So IRR works really well for lenders and bonds like that. Doesn't work as well for sponsors. But I wanted to show it to you with Apex to illustrate the opportunity cost of capital and how that's such a great thing. Um, but you may have noticed down here at the bottom of the spreadsheet, um, in the summary for equity, I have NPV, net present value, and I have a question mark to be determined. That is actually the next thing that we're going to look at in the next video coming up. Um, and net present value is a discounted cash flow method of evaluating projects, just like IRR. So first thing we're going to need is comprehensive cash flows for the sponsor to help us evaluate any project using the NPV method, just like IRR. And also to use NPV, we're not going to be able to think about NPV or compute an NPV without our opportunity cost of capital. So I wanted to introduce opportunity cost of capital before we jumped into NPV. That's the next thing we're going to jump into. That's going to be in the next video. Okay, that's it for now. So once again, I will say sayonara until the next video.